So this is a subject that was asked for a few times, and I think I've covered it in the past, but in different sessions. But um, what I want to cover here is adding into positions. Now, there's two aspects of this. There's adding into a position that you want to be in, and it's going fractionally against you, and I'll explain that in two ways in a moment. And then there's the adding into the winning position. So there's adding into a position you want to be in, and there's adding into a winning position. So I'm going to take the first of being adding into a position that you want to be in. Now, there's two ways of doing this. There's or two aspects of this as well. There's the first one is where you've got a predetermined entry that would be the ideal entry. Um, so if you've got a predetermined entry, and that's your entry. However, let's say for a long position, you've got a couple of areas of potential support in the way. So if you've got the support in the way, you think, well, actually, rather than miss the trade altogether because the potential, let's say, is strong to the upside, I would take a part of the position here. Let's say I'll put one or a quarter in here, and then there's another level of support. I'll put another quarter in there, and down to where your entry is. So that is one way of doing it, and to me, it's the only way of doing it. There's the other thing which is often referred to as dollar averaging, and you'll see it mostly it's a stock trader's favorite as well. Is where you've got your entry at the the ideal entry, but then the trade starts going against you. So you start thinking, well, actually, if I add in a little bit here, so you've gone in at the entry with your full size that you wanted to. So you've gone in with your full size, but then you're adding in going over the full size. So you've taken the entry of, so this is the averaging. Averaging in into a position which is going against your entry, your ultimate entry. So in effect, it's going wrong. So you've already gone full size. You're then starting to add into it to bring the cost of the trade down. So if it's just draw a picture here. So if you wanted to get in, let's say up here into the 8 moving averages, it was on the dailies there, and that was it. The ultimate entry was there, but then you start averaging in here and here. You're going against, this is dollar, I say dollar averaging in stocks in terms it would be referred to as. Now this for me is an absolute no-no. And in this particular case, there's you say, yeah, it worked, and that's the problem. It does work some of the time, and I know of some traders they would do this and they will average and average, and of course their 1% original risk or 2% original risk or whatever it may have been to start with suddenly becomes 20% or more risk because they don't want to lose. To me, this is absolute. I've done it, and I'm speaking from experience. It's rubbish because in the end, what happens is they get all of this averaging going on. Price might come a little bit further against them, and they add in some more into this 50 because there's good reason to add into the 50, of course, isn't there? So you think, well, okay, yeah, I've added in here, and I'll add into the monthly pivot because it's bound to bounce off that. It carries on. It gets, oh, there's a 34, I'll add into the 34. Oh, there's the 50, I'll add into that, and before you know, it, you may be even beyond 20%. So this, I'll cover this first in terms of the explanation. To me, it's ridiculous. You may as well get stopped out, make a small loss, whether it be your 1% or whatever else, and reassess. And if the opportunities back here or down here are there, take them. But don't sit in there adding into risk, which in a trade that is going badly. So I just need to get that out of the way because there's all sort of this I know people do it. As I said, I've done it myself in the past, and I've been into very high elements of risk. And of course, the next thing, what happens is because you end up with the thing coming so far against you, you get in. When it gets up to your average level, wherever it may be here, what do? Get rid of that. Phew, that was bad. God, thank goodness I made $50 or something. You know what happens then? Of course, it flies up. Yeah, you close into the average when you're just above break even. This is why a lot of traders lose money because they don't want to lose. They don't want to be wrong, and being wrong is part of trading, and we can all do it. And I think you see Charlie regularly says it. You see me, I'll regularly be wrong. I'd rather be wrong than out of pocket by a significant amount. There's nothing worse than this sort of thing happening. And as I say, whenever you do this, whenever I've done it myself, I've got into profit, got up a few quid, and you've averaged it. You might have done it over a day, and you've ended up from being in a significant loss, and you've just broken even, and you've made a couple of quid, and that's it. Anyway, for me, it's got to be a no-no, and I'm quite happy of admitting my losses and call the trades in the room. You'll see we lose, but we'll go back into trades at times. Anyway, so that's one situation which I say is no, no. But the one that I do like is if there's an opportunity, and it may be that I want it. Let's take this exact same sample. I want to get in on a retracement to the pivot. Let's say that's my ultimate aim for this. It's the euro I'm looking at here. Let's say I wanted to get in at the pivot. However, there are a couple of areas beforehand which may provide a bit of support and may see it go off. Now, I could say, well, actually, I'll just tip my toe in the water with a quarter of a position hit there. I may add, when it comes down to here, add in another quarter. Okay, I can put the half in, and I'm in now. And then you've got to balance your risk off, of course, because of those positions going in there. It's got to all balance in there with your ultimate stop. Your original stop has got to be determined from this entry here, of course. Um, if you're doing it this way, it's got to be determined from where would the stop be for this? And you say, well, actually, I might slip it below the 50, or there may be a 1.5 times average true range, which probably won't be a lot shorter. So wherever your stop is, that's the stop for the position. Um, Now, for these positions, you may say, well, I'll be a bit more aggressive for the stops, but you could just get a slight bit of overrun and get into trouble, and it may just confuse things. But you've got to balance the risk off and check your calculations of what you're going to be adding into these positions. It may be less than a quarter of the position, maybe an eighth of position, main position there. But I mean, the thing is, the reason we go into these positions is because of the fear of it just running off without us. Of course, I say fear, but well, there is an element of missing out. So that's why we add in. The ultimate is here, but it may not get there, and we're very aware of that, particularly when you've got such a strong move in this market, and the one I'm showing here. So that's it. That's how I'm looking to add into a position to get what I call the initial trade. So then when you're in the initial trade, it's the adding in to the winning trade. Now, this has to be worked out quite carefully because an important consideration is where is the ultimate target of your trade. Now, sometimes it may not be. You have to go right back to the very high time frames because with this euro move, where would have been the ultimate target if you sort of, let's say you're thinking about around about this time here, you started getting bullish. I don't know if this was the time. It was about 19th of June. When was it? Let's just tie it up with a chart so it makes a little bit more sense. 19th of June. So you look at, okay, so we're going back a little bit. We're looking, and we've seen this happen here. We're starting to think bullishness. Where's the target going to be? It's pulled back. It's got some nice support here. I'm interested in the trade. It's at this point here, really, that you need to, well, obviously you need some sort of target. Now the target might be moving, but if you were looking at the bigger picture and you're sitting around that area, there's a few different targets that I would never ignore the horizontal levels of where you may find support or resistance, and resistance in this particular case. So I mean, we're just on this June area. You're sitting around this first sort of area, and well, there's the risk obviously of that. But that, I mean, I know what most people will be looking at is that 200 moving average up there. I know, okay, you can see that it's hit it on this particular occasion, but it's got to be a decent target. But there's maybe a sub target coming in through these with these other, as I say, this other horizontal stuff. So you can't ignore that, and it would not have been ignored. You can see with how the weekly reacted to it. It did have a reaction, sold off for a week, recovered towards the end of that week there. But this is easy retrospectively. But you've got to consider where your targets are. It may be this is a part target and that's the full target. That's for you to determine, or whether you want to just try and push it all the way up to that 200. But that is at the outset of trading, and particularly when you're considering adding in, that's got to be in your mind in terms of what you're doing. You've got to say, well, actually, where was the 200 moving average? Let's just come back to that. That was sitting at that time, well, back in the time when we'd have been looking at it, maybe sitting about 1818 time at that time. So okay, it's a diminishing target, but it would have been looking at 1818. Let's just put that as a horizontal line. I'm going to put it around about there. Oops, he says. I was hoping to put it on there. Sorry guys, it's just got. I'll just put it slightly lower. Okay, so there's that would have been the ultimate target when you was looking at back in June. So then you can work out potential add-ins as you run through and as the days progress. Two possible ways of adding in then, or main points of adding in. There's the breakout type or the retracement type. Preferably, I like retracements. I just think they're easier to get in. Oh, I say easier to get into. They're neater. What I mean by the breakout type is, just bring this up here. I'm going to draw this really badly. I'm not even going to draw it at all. I'm going to put a pen on here. I'm going to put this on here, and I'm going to get into the right point there. Okay. I can say, well, actually, if it breaks that area, I'm going to add. So first position down here somewhere. By that point, I'm up a decent amount of profit. I've got a stop down here. I've got this huge target all the way up there. I've got a fantastic potential. Now, as I say, this is fantastic because I can see what's happened. It's very easy, but it's the theory behind what you should be looking at is important here. So the stops down here, the target's way up there. I can, yep, okay, I can take the breakout type entry. So it's broken out. Of course, the risk of that is that it will potentially retrace, but it's still an option, and it's a tradable one. Personally, I like retracements. So a breakout of the 8, a break above the 8, retest the 8, and that's the secondary type entry. Or in this particular case, you could have probably added into both. Consideration then has to be of where you're placing the stops on the add-ins, because I know some people will add in here and then put the stop too tight. It may be that when you're doing this, you start averaging it. I say averaging in, but averaging the other way, and start using this amount of profit as the element of stop, and start. You could actually, if it's up to here, you could probably put your stop below the lows there, leaving the other stop where it is for now. Or you may even want to tighten that up over. I mean, that comes to stop management, which is almost a different subject in its own, or it is a subject on its own and can go on for that forever. But in terms of adding to this trade, you're adding on in this point here. Next point, you can either add on the break, wait for the retrace to that level. May never come. I mean, that you'd get into the next month, look at these monthly pivots with the 8 and everything else, and I think that would be an opportunity to add in there. Even if you did add in there, you may add in another position here. And then from there onwards, in terms of add-ins, there may be other factors that I'm not seeing, but it's really up to. I mean, you may have an incremental add-in. That could be the other option as well. Every time you get up 100 points, or 200 points, you add in, and that's probably a third way of doing it, which is not technical. Here, technicals, I'm looking at sort of you've pushed up, broken a new high here, pulled back, retested a weekly pivot. So you may be using the weekly pivot as a step. So there's a potential weekly buy-in from there, um, and push in. When you've extended away from a moving average by quite some way, you've got to be a bit careful, because often multiple hits, we know it'll roll at some point, and it did eventually roll back here, over here, but by which time it would already hit that original target of the 200 MA. So that's the principle behind it. I find it's much more difficult to add into a position when it's just doing this, unless you just say, well, actually, I'm so many points up now. There's no reason why it won't continue up towards that 200. I can afford to pop in a break of this previous high here, for example, on the push up there, and take the break and add in on these break type positions. This was a bit more difficult here, maybe back to the 8, add in, but you could use a combination of providing here, by the time you get to these points here, you're going to be so much into the money, you're actually risking your trading money, and not you're risking your profit and not your um, actual sum of cash. So your equity itself, so you're trading on profit at these points, and of course by the time you're getting up here, there's no reason to have the first stops and all these stops down all the way still down here, and the sort of add-ins as you're going along down here, etc., or wherever you're putting them as you're going along. You can start moving all those stops up, so you've got a firm stop up here probably as you're buying in on this last one here. But when you're buying on this last one, you've got to make sure, well, does it make sense if I'm going to have to put a stop down here? I would still look at the amount of what you're adding in. Does it make sense? So there we go. That's basically it. So as I say, probably three options to get into the winning trade. One, look for the prior highs, look for the breakouts if it's on fire, and you can look at using momentum. You can just look at what the hell's going on. This is a daily chart, so just one bar may not be quite comfortable for you. But in the main, it's if they break out, maybe you could be looking at the order book, see the orders as well chunky above that area, and it's worth the add in at that point, or you can wait for the retracements. Now, on a good trending trade, and you don't know how, because look, if you looked at doing the same thing here, it would have been chopping all over the place. You'd have, wherever you decided, whatever the entry was and what your next target was, this is reality at times. It's not necessarily the best month to be trading and looking for the swing position necessarily. August, September, markets can go choppy. So you could have said, well, actually, I won't do it. Retrospectively, again, that's easy, because I've seen some Augusts that just far off, and we had it when a couple of years previously. So to summarize then, first option, break on the trends, add in on the retracements. Third option, incremental option, that 100 pips, whatever it may be on a bigger move, 50 pips on depending on expectation, you can add in incrementally like that as well. There's nothing wrong with doing that, but technically I prefer to look at watch the market there. The thing is to keep, if you're looking and you're adding into the time frame you're adding in your trading, stick to it. Don't be put off by the noise on the lower time frames. So if I was doing this as a swing on the dailies, this could be an intraday trade I'm looking at. I must admit, intraday I find it more difficult to often add in, because of the probability of it only going 80 pips. So you're sort of up 30. If it's moved 40 and you've got 40, you think, well, time I add something in there, it's a little bit more difficult. It's easy to add into the initial trade, but negatively. What I mean by getting a tad early, add a little bit, if it comes against you a little bit where you're expecting, down to your required entry. It's easier to do that on an intraday trade. Not so easy always to add in to the intraday trade if there's only sort of, as I say, 80 pips maximum and you're already up 30 or 40. So you've got to bear that in mind. Always consider the exit look at where the exit is relative to the trade and your position you're in. Because if there's only 10 pips left in it on that lot, there's no point incrementally adding in for that last 10 pips probably. So there we go, guys. So certainly you can come down to the smaller time frames for the entries, for the add-ins, and get more eloquent entries. But always be whatever time frame you're trading on, look at that as the master. And you may look at that, and of course the upper time frame, because don't be blinded by anything that's sorry, I say blinded. Don't miss out on something that may be sitting up there that is equally important. But you should be doing that analysis when you're thinking, well, actually, I'm going to trade up to that weekly 200. You should be looking at the potential risk and the points. Okay, I'm going to end the recording there. Thanks, guys.